Hi! Today, I'm coming to you in cartoon form. Because let's be honest, reality is overrated and pixels never age. Like me, right? Well, why? Why am I doing this? Because I can. And because if plug power can turn water into hydrogen, I can turn myself into a walking, talking financial hologram. So buckle up, InfoNauts. This isn't just a market update, it's Saturday morning cartoons meets investor due diligence. Let's go. Plug Power just got a $525 million lifeline, but will it save them from getting delisted? Welcome aboard, fellow InfoNauts, your trusty space shuttle through the swirling galaxy of data, dollars, and drama. Today we're docking at Planet Plug Power, where the hydrogen fuel gods are either plotting a comeback or writing their farewell tour. You might have seen Plug Power's stock dipping lower than your cousin's crypto portfolio, or heard whispers of that dreaded word, delisting. Yeah, the thing that turns promising companies into financial ghost ships drifting off the NASDAQ radar. So, what's the deal? Why are investors biting their nails, and why did the stock go up on April 28th, only to fall again like an over-caffeinated pigeon? Let's break it down. Because while Plug Power just landed a $525 million secured debt facility, we're still watching them like a stressed out babysitter with a toddler near a fish tank. On April 28th, 2025, Plug Power pulled a classic hold my hydrogen move and dropped two big announcements. They secured a $525 million debt deal with Yorkville Advisors. They reported some not too shabby preliminary Q1 2025 results, expecting approximately $130 million in revenue. And yes, Wall Street loved it for like 24 hours. The stock briefly soared. Investors cheered. Hope was restored. Then reality hit, and the stock dropped to 88 cents per share, down 7.3%, like someone realized mid-party that the punch was just Kool-Aid. So, here's the first question I had. Why did Plug Power's stock briefly soar on April 28th in the Let's Make It Great Again year of 2025? Simple. Investors got a dose of good news from two directions at once. $210 million in fresh capital. Plug announced the first chunk of a $525 million loan from Yorkville was fully funded. That's real money in the bank, not just a press release promise. It showed investors they could pay off risky debt and keep the lights on. No more dilution for now. Part of that money, $82.5 million, was used to retire old convertible debt that could have dumped 55 million new shares into the market. That means investors' existing shares didn't just dodge a bullet, they dodged a dilution asteroid. Better than expected Q1 results revenue came in between $130 million and $134 million, which lined up nicely with analyst expectations, and they promised an additional $200 million plus in annual cost savings. That's called tightening the ship before launch. Put it all together, and you get a short-term confidence boost. Investors love when risk goes down and capital goes up. Why did it fall again after? That's another page. But in that moment, it looked like Plug was finally plugging the leaks. My next question, so $82 million was taken from the $210 million that was fully funded. Where did the rest of it go? Well, as we have come to realize, Plug Power secured a $525 million credit facility from Yorkville Advisors, with an initial $210 million tranche fully funded around May 2nd, 2025. Of this, approximately $82.5 million was used to retire existing convertible debentures held by Yorkville, reducing potential dilution from about 55 million underlying shares. The remaining funds from the initial tranche were allocated to support Plug Power's operational and growth initiatives. This includes ramping up hydrogen production facilities, such as the newly completed 15-ton per day plant in St. Gabriel, Louisiana, operated through the Hydrogenii joint venture with Olin Corporation. The facility aims to strengthen Plug's vertically integrated hydrogen network and serve major customers like Amazon and Walmart. Additionally, Plug Power has implemented cost-cutting measures expected to generate over $200 million in annual savings. These initiatives, along with the new funding, are intended to enhance the company's financial position and support its path toward profitability. As of March 31st, 2025, Plug Power reported approximately $296 million in unrestricted cash. The company anticipates that the current cash resources, combined with the cost reduction initiatives and additional committed financing available under the Yorkville credit facility, will provide sufficient liquidity to support its growth in the near to mid-term. In financial and business terms, near-term typically means the next 3 to 6 months. Mid-term usually refers to a period of 6 months to 2 years. They believe they have enough cash and credit to operate and fund expansion for at least the next few quarters, possibly up to 2 years, without needing to raise more money. Moving on. Okay, so what is a secured debt facility? Okay, pause. Let's explain this for the InfoNauts who skipped Finance 101 to watch alien documentaries. A secured debt facility is basically a big loan, but not your shady Uncle Tony kind. It's tied to company assets, meaning if Plug Power doesn't pay up, Yorkville gets the metaphorical keys to the hydrogen factory. So why does this matter? Because Plug had existing convertible debentures, fancy IOUs that could have diluted shareholder value. This $525 million Lifeline helps them pay off $82.5 million of that, reducing the risk of more shares flooding the market like a leaky spacesuit. That's good for shareholders. Less dilution equals your slice of the pie doesn't shrink into invisibility. Repayment terms. While specific repayment dates and terms haven't been publicly disclosed, secured debt facilities like this typically have structured repayment schedules over several years. Failure to meet these obligations could lead to consequences, such as increased interest rates or potential claims on company assets. Understanding the convertible debentures. What they were. Prior to this deal, Plug Power had issued convertible debentures to Yorkville, which are debt instruments that could convert into equity, potentially diluting existing shareholders. Impact of retirement. By retiring $82.5 million of these debentures, Plug Power reduced the risk of dilution from approximately 55 million shares, thereby protecting shareholder value. Possible key takeaways for the shareholders. Reduced dilution risk. The retirement of convertible debentures lessens the threat of share dilution. Improved liquidity. The infusion of capital strengthens Plug Power's balance sheet, providing funds for operations and growth initiatives. Focus on profitability. With this financial restructuring, Plug Power aims to streamline operations and move towards profitability. This strategic financial move is most likely designed to stabilize Plug Power's finances and position the company for future growth, aligning with shareholder interests. Also, remember, this is not legal financial advice. This is awareness of financial terminology in relation to what it could possibly mean for Plug Power or any company given these circumstances. What previous convertible debentures did Plug have that were worth $82.5 million? And who was that with? Prior to this deal, Plug Power had issued convertible debentures to Yorkville, which are debt instruments that could convert into equity, potentially diluting existing shareholders. What are convertible debentures? And why do they matter? Let's quickly break it down. Convertible debentures are like IOUs, but with a twist. Plug Power borrowed money from Yorkville Advisors using these debt instruments, but instead of just paying Yorkville back in cash, the agreement allowed Yorkville to convert the debt into Plug Power shares, stock. Translation. If Plug can't or doesn't pay back in cash, Yorkville can say, cool, we'll just take a bunch of shares instead. The catch? This increases the total number of shares on the market, which dilutes the value of your shares, like slicing the same pizza into 16 pieces instead of 8. You still get a slice, but it's smaller. So when Plug used $82.5 million from the new loan to retire those convertible debentures, they effectively said, no more pizza splitting, we'll just pay it off now before it costs everyone. That's a win for shareholders because it limits dilution and shows Plug Power is trying to clean up its balance sheet. Just so we can understand clearly, did Plug Power borrow money from Yorkville to pay back Yorkville? Yes, essentially. Plug Power had older convertible debt already owed to Yorkville Advisors. That debt could have been converted into stock, diluting shareholders. So they negotiated a new $525 million secured loan, also from Yorkville, and used $82.5 million of that to pay off the older convertible debentures. It's like refinancing your credit card debt with a new loan, from the same lender, but with better terms and fewer strings attached. So, why do this? To avoid share dilution, to reset the terms under a new structured deal, and to show investors they're getting their financial house in order weird? Yeah, a little. But strategic? Definitely, if it buys them time and credibility. So, it looks like this is doable because Plug Power's equity has increased over time since the first loan, so their asset value is more. So, Yorkville was willing to do this because they see the value roughly. And so, there you have it, some of the underlying logic behind these transactions. Yorkville likely agreed to this new deal because Plug Power's equity and assets now represent more value and potential upside than before. A few reasons why Yorkville would be on board. Plug's growing infrastructure, with hydrogen plants now operational, like Louisiana, Georgia, Tennessee. Plug is turning previous promises into real revenue-generating assets. That adds hard value to their balance sheet. Bigger customers, better contracts, clients like Amazon, Walmart, and Home Depot increase Plug's credibility and long-term revenue visibility. Reduced dilution risk equals better optics. By using the new structured loan to retire old convertible debt, Plug signals financial discipline. Yorkville benefits too. They'd rather collect interest on a cleaner loan than flood the market with diluted shares nobody wants. Plug's long-term vision is alive. Even though they're not profitable yet, Yorkville likely sees Plug Power as a recovering growth story that just needed cleaner books and breathing room. So yes, Yorkville likely sees more asset value, more execution, and more potential upside now than when the old convertible debentures were issued. Section 4. Planting seeds. Literally. Plug wasn't done. Earlier, on April 23rd, they opened a shiny new liquid hydrogen plant in St. Gabriel, Louisiana. It produces 15 tons per day, bringing Plug's total North American output to 40 tons per day, including plants in Georgia and Tennessee. Their clients? Oh, just some familiar names: Amazon, Walmart, and Home Depot. The new plant is part of Hedrogony, a joint venture with Olin Corporation, who brings electrolytic muscle to Plug's hydrogen hustle. Section 5. So, are they getting delisted or not? The looming asteroid in Plug's orbit. Delisting risk. Let's address it. If a stock trades under $1 for too long, NASDAQ can delist it. Plug has been flirting with that line longer than your friend who says they're just talking to their ex. But this new debt deal, the positive Q1 results, and the hydrogen plant expansion all suggest they're fighting back. Are they out of the woods? Not yet. Does a person need to see a leak plugged, no puns intended, to know that a Plug's leak can be plugged? No. But are they at least holding the map right side up now? Yes. Follow-up question. What gets a company kicked off the NASDAQ? All right, InfoNauts, let's talk about how you get voted off the NASDAQ island. NASDAQ has a checklist. If a company slips up, they risk getting delisted. Here are the top 3 red flags. Number 1, if stock price falls below $1. If your stock trades under $1 for 30 consecutive business days, you're in danger. That's the big one Plug Power's dancing around. Number 2, if market value goes too low, your market cap must stay above $35 million. Fall below that for 30 days? Uh-oh. Number 3, shareholder equity. You need at least $2.5 million in shareholders' equity if you're not profitable. Too much debt and not enough assets? That's a no-go. Bonus metrics. NASDAQ also checks for late SEC filings, low trading volume, and fewer than 400 shareholders. In short, if you're too small, too quiet, or too messy, you risk getting ejected off the big boy money island. So let's segue over to an example for one moment on a company that did get delisted, but then got relisted so we can understand the pros and cons of this situation long term. Why did Hertz get delisted? Let's plug this into real life. Hertz scenario. In May 2020, Hertz filed for Chapter 11 bankruptcy. Translation: they ran out of cash, travel demand vanished, and they had $19 billion in debt, with no way to pay it off. As a result, their stock price fell under $1, their market cap tanked, and they couldn't meet NASDAQ's financial requirements, like shareholder equity or filing deadlines. NASDAQ gave them the "you're out" notice and delisted them in October 2020. But here's the kicker: delisting didn't kill Hertz. They restructured, cleaned up their balance sheet, and by November 2021, they relisted on NASDAQ, leaner, smarter, and with Teslas in tow. So yeah, Plug Power could trip some wires, but like Hertz, a smart reset could be part of the journey, not the end. Section 6. Why this isn't the end, even if it was delisted. Let's imagine worst case scenario. Plug does get delisted. Does the company explode? No. They still own plants, tech, trucks, contracts, partnerships, and now a decent war chest of cash. Delisting just means it moves off the Biggie League exchange. But sometimes that gives companies room to regroup without the constant glare of public markets. Think of it like switching from playing on ESPN to training behind the scenes. Yeah, fewer fans, but more focus. And if Plug's long-term plan works, hydrogen infrastructure, big-name clients, cost-saving measures, this setback could look like a pit stop in a galactic journey. So comment, like, and subscribe. But we're not done yet. Delisting isn't death, the Hertz comeback story. So once upon a time, Hertz, the rental car company, went from bankrupt to baller. In May 2020, Hertz filed for Chapter 11 bankruptcy. Travel had collapsed, demand was as dead as zombies, and they were over $19 billion in debt. NASDAQ delisted them fast, because, let's be honest, zombie companies don't belong on big league boards. The stock fell under $1. Retail investors piled in thinking it was cheap, not realizing bankruptcy meant they could lose it all. But here's where it gets interesting. A bidding war broke out. Investors, including Knighthead Capital and Apollo Global, saw Hertz's potential post-COVID. They backed a reorg plan, wiped out the debt, injected new capital, and let Hertz reemerge with style. By late 2021, Hertz was relisted on NASDAQ under the ticker HTZ, and it came back with over $13 billion in valuation, plus a new EV strategy featuring 100,000 Teslas. Lesson? Getting delisted or going bankrupt doesn't mean it's over. If the core business is solid, it can come back leaner, meaner, and smarter.
Just like me.
I mean, like Plug Power could. So yeah, Plug Power getting delisted wouldn't be fun, but it could just be Act 2. Section 7. The cost-cutting warp drive. Now, let's delve into something every investor loves: savings with a lisp. Plug announced cost-cutting moves projected to save them over $200 million annually. That's not skip the avocado toast savings. That's launch your own avocado farm on Mars kind of scale. If they pull it off, this could make the difference between being a company with Coolio ideas and being a profitable force in the hydrogen sector.
Let that sink in just a little bit. And in Section 7, it thus came to be that the Plug Power did cut the chaff from the wheat.
What exactly is Plug cutting to save $200 million? We will never know. Joking? We will soon find us out, Arcad. All right, InfoNauts. Let's look at what Plug Power is trimming off the spaceship to, in Samwise Gamgee's words.
Help lighten the load.
First, headcount and contractors. They're reducing labor and outside help. Fewer people equals fewer paychecks. Second, CapEx and R&D delays. They're slowing down on building new sites and tech investments. That means no new billion-dollar hydrogen moon bases, for now. Third, supply chain optimization. They're renegotiating contracts, streamlining parts, and cutting inefficiencies in how they get hydrogen from point A to point B. But hopefully, it won't be as extreme as those darn tariffs. In short, fewer hires, fewer projects, tighter logistics. Contrast that with before, when they were spending like they'd already won the hydrogen war. Now, they're tightening up to survive long enough to win it.
And on the 8th day, Plug Power said, "Let there be infrastructure." And lo, some plants were built, and some were, well, put on hold while they searched for funding and divine patience.
Final thoughts. What this means for InfoNauts. So here's your cosmic download. Plug Power isn't out of the nebula yet, but they're pointing their thrusters in the right direction. The $525 million isn't just a band-aid. It's a bet that they're not done yet. The Louisiana plant and major clients show real infrastructure, not just vibes. Yes, delisting is possible, but it doesn't mean the death of the mission. Whether you're holding plug stock, watching from the sidelines, or just love a good hydrogen drama, this is one to keep your scanners locked on, in my unhumble opinion. That's it for today's transmission, fellow InfoNauts. Be sure to like, subscribe, and drop a comment if you think hydrogen is the fuel of the future, or just really like the word debenture. Until next time, keep exploring the universe of knowledge one data point at a time.